Hello, I'm Bernard Hickey from interest.co.nz and welcome to a Reserve Bank special report where Alan Bollard, the Governor, has today kept interest rates on hold, the official cash rate at 8.25%. But he has signalled that he can cut interest rates later this year because the economy is slowing very sharply. And he says inflationary pressures will start to ease over 2009 and 2010. He's got a very difficult situation where the economy is slowing very fast because household spending is dropping. The housing market slowdown there is a big factor. But at the same time, higher fuel and oil prices are coming through from offshore and they're bumping up inflation. So much, in fact, that inflation will jump to 4.7% in the September quarter, and that's the highest it's been since 1990. So the Reserve Bank is saying, hey, yes, we have this 1 to 3% target band and inflation will jump outside that, but we're choosing to look through high oil prices, higher food prices, and also the effects of the emissions trading scheme. And we are confident that inflationary expectations will not rise much above 3% and that therefore we can afford to start cutting interest rates later this year. Now that's dependent on an oil price falling below $100 a barrel and food prices not rising that much further. So the Reserve Bank Governor has decided to stand pat. And as you can see now from this interview with Alan Bollard with interest.co.nz, he does see some concerns for the economy and he does have an outlook that the New Zealand dollar will fall too. Okay. Dr. Bollard, why have you decided to say you can cut interest rates perhaps towards the end of this year?
Well, we haven't definitively said that. We've said we've put out an interest rate track that's consistent with doing that, though, and that's because we see domestic inflation coming off and we see a softer economy and we see a more negative terms of trade picture. And so we think that underlying inflation is coming off despite these very high headline numbers, but also we see the economy softening and that will help bring inflation numbers off. Was
the budget inflationary?
That always depends compared to what. And compared to locking up the money, yes, a bit. Compared to spending in other areas, not necessarily. So sorry, I can't give you a simple answer because it's actually quite a complicated question.
Do you really think that oil prices are going to fall and therefore that inflationary expectations won't rise?
Well, the cream of economic forecasters around the world think that, so who are we to think any different?
And on the exchange rate, you said there's a risk that it might fall quite sharply. Can you talk about what might happen if that's the case? No,
that's hypothetical. We're simply noting that if the exchange rate were to fall significantly, that has a real impact on inflation and that comes right back in our face on the sort of way we've got to look at monetary policy. We don't expect that to happen. What we do have factored in a softening in the exchange rate, but and that's there in our numbers. But were we to see it really falling, then that would be a much more concern to us.
Just finally, what do you see for the economy over the next couple of years in terms of economic growth, consumer spending, and how do you see the housing market?
We see the housing market going through a dip where nominal house prices drop by around 13% over 2 years. And that's more of a dip than we've had for quite some time. That drives household consumption very flat, and once that happens, the economy is flat because that's the big part of the economy.
Dr. Bollard, thank you very much.
Thank you.